Hey everyone, welcome back to Corporate Decoder, the place where we unpack big business secrets and reveal the real story behind the numbers. Today we're diving into an updated filing from New England Realty Associates, or NERA, and let's just say they've been busy buying up property. Stick around because we're going to decode what this acquisition really means for their bottom line. Before we dive in, if you find value in getting straight to the heart of corporate filings without the jargon, do me a favor and smash that subscribe button. And for those of you who love to debate these insights and connect with like-minded folks, our Discord community link is in the description below. Alright, so NERA has filed what's called an 8K CAN form. Think of this as an amendment to a previous report. Back in June, they told us they had completed a big acquisition, and this filing is to add in the important financial details that are required when you buy something significant like this, especially when real estate is involved. This report is dated September of 2025, but it's talking about events that happened as early as June 2025. They're essentially catching us up on the financial picture after a major property deal. The company New England Realty Associates Limited Partnership, which we'll call NERA for short, acquired a bunch of properties. They bought a big multifamily and commercial real estate property plus 2 other commercial buildings. This was all happening in various spots around Belmont, Massachusetts. The deal itself was agreed upon back in April of 2025. They signed something called a purchase and sale agreement, which is the legal document outlining the terms of buying property. Let's talk about what they actually bought. We're looking at a massive property called the Hill Estates Properties. This includes 396 apartments spread across 28 buildings. It also has a maintenance building, an office building, and a mixed-use building with retail on the ground floor and apartments above. Plus, there are about 58 parking spaces. Imagine managing all of that. On top of that, they picked up 2 more office buildings, one at 26 Brighton Avenue and another at 90 Concord Avenue in Belmont. The price tag for all of this, a cool $175 million. Of that, $172 million was for the main Hill Estates complex and just $3 million for those 2 separate office buildings. That's a significant investment for NERA. The actual purchase or the closing of the deal happened on June 18, 2025. NERA used its own subsidiary companies to make the purchase, which is pretty standard for real estate deals. Now, how do you pay for a $75 million purchase? Well, they didn't just use cash. On the same day they closed the deal, one of their subsidiaries, Hill Estates NERA, LLC, took out a loan for $67.5 million from KeyBank. This loan is secured by the property itself, and NERA, the main company, is acting as a guarantor, basically saying they'll cover it if the subsidiary can't. This means if they don't pay back the loan, KeyBank can take the property. The interest rate on this loan is floating, tied to something called the SOFR rate plus an extra 1.5%. It's due back by December 2025. On top of that, NERA borrowed another $40 million from its existing credit line, where they have a fixed interest rate of 5.99%. They also used cash they got from selling US Treasury bills to cover the rest. So this acquisition was definitely financed with a mix of debt and their own cash. Remember how I said this was an amendment? That's because the original report in June didn't have these detailed financials. Now they're providing them as required by regulation, and that's what we're going to dig into next. This section is all about the financial data. They've included the audited financial statements for the acquired properties for the year ended December 31, 2024, and also the unaudited financials for the first 3 months of 2025. There's a report from an independent auditor, which is basically a check to make sure the financials are presented fairly. The auditor says the statements show the revenues and certain expenses fairly for the year 2024, following generally accepted accounting principles in the US. They also note that these statements were prepared specifically for the SEC filing and might not show all the company's expenses like depreciation or interest. Now let's look at the actual numbers for the acquired properties. For the 3 months ending March 31, 2025, the rental income for these properties was about $2.5 million. For the full year ending December 31, 2024, it was about 10/31, 2024. It was about $10.3 million. That's a decent chunk of money coming in from rent. On the expense side, for the first 3 months of 2025, the certain expenses, which remember exclude things like interest and depreciation, were about $1.1 million. For the full year 2024, these expenses were about $4.2 million. For the full year 2024, taxes and insurance were also significant at over $1.5 million for that year. So after deducting these certain expenses from the rental income, The properties generated about $1.4 million in excess in the first quarter of 2025 and about $6.1 million for the full year 2024. This is the money left over before considering financing costs or other corporate overhead. In the notes to these financials, they reiterate that these statements are prepared specifically for the SEC filing and exclude certain expenses that wouldn't reflect future operations. This is important because it means these numbers aren't the full profit picture, but rather a focused look at the operational income from the properties themselves. They also clarify how they're presenting this information. The statements only include the accounts for the properties purchased on June 18, 2025, now collectively called Hill Estates et al., or the purchased property. Again, they emphasize they've excluded things like interest expense, depreciation, and other corporate costs. This is crucial context when you look at profitability. You need to remember that fact that they have millions in loans means that actual profit will be lower than what these statements show, because interest costs are excluded here. The financials for the 3 months ending March 31, 2025 are unaudited. Management believes they reflect all necessary adjustments for a fair presentation, but they stress that these interim results aren't necessarily a preview of future performance. Now let's get to the pro forma statements. Pro forma means as if these are financial statements, adjusted to show what the company's financial situation would have looked like if the acquisition had happened at an earlier date. This helps investors understand the combined company's potential financial picture. This balance sheet as of March 31, 2025 shows what NERA would look like if they owned those new properties and had taken out those loans from the beginning of the year. Let's look at some key numbers here. On the asset side, NERA's original rental properties were worth about $283 million. With the acquisition, they added another $168 million in rental properties. In total, pro forma, their rental properties jumped to over $451 million. That's a huge increase in their asset base. See this line here? Investment in US Treasury bills. They had about $58 million in these, and it went down to zero in the pro forma. This reflects the cash they used from selling these treasury bills to help fund the acquisition. Selling safe assets like treasury bills to buy more real estate is a significant strategic move. And now for the liabilities. NERA's original mortgage debt was about $405 million. The acquisition added another $107 million in mortgage debt from that key bank loan and the credit facility. So the total mortgage debt pro forma is a massive $512 million. This shows how heavily leveraged they are after this deal. And look at this partner's capital number, it's negative. This means that the company has accumulated more losses than capital over time. So while they've acquired significant assets, the company itself has a negative equity position on paper. This is a red flag suggesting that the company's total liabilities on their own books exceed their total assets by over $71 million. Let's move on to the income statement, which shows how much money they made and spent. For NERA's own operations before the acquisition, they had rental income of about $20.5 million in the first 3 months of 2025. Adding the acquired properties $2.5 million, the pro forma total rental income is about $23 million. So a roughly 11% increase in rental income from adding these new properties. Depreciation and amortization jumped from about $3.9 million to over $6 million pro forma. This reflects the accounting way of recognizing the cost of the acquired buildings and improvements over their useful life. It's a non-cash expense but impacts reported profit. They've adjusted the management fee. Historically, NERA paid out about $818,000 as a management fee in that quarter. For the acquired properties, it was $340,000. The pro forma shows a reduced combined management fee of about $894,000, mainly because they brought the acquisition's management fee rate down. Here's a critical number, interest expense. NERA alone had about $3.8 million in interest expense. Pro forma, with the new loans, it's a whopping $5.4 million for just 3 months. That's a lot of money just to service the debt. So what's the bottom line? After all the revenue, expenses, and importantly, the adjusted financing costs shown in these pro forma numbers. NERA's net income for the first quarter of 2025 would have been about $739,000. This is a pretty small profit considering the scale of the operation and the debt they've taken on. Let's look at the full year 2024 figures for comparison. ANA's historical rental income for 2024 was a healthy $79.8 million. When you add the acquired properties $10.3 million, the pro forma rental income is over $91 million. That's an 11.5% increase from the new properties. Depreciation and amortization for the full year jumped from about $17 million to over $30 million pro forma. This is a substantial increase due to the new assets. And the interest expense for the full year 2024, it's a staggering $21.8 million pro forma. This means that nearly a quarter of their rental income is being eaten up by interest payments on their debt. For the full year 2024, after all adjustments, NERA would have reported a net loss of about $717,000. This is a significant shift from their historical profit of over $15 million. The acquisition, while increasing rental income and asset base, has turned them unprofitable on a pro forma basis, mainly due to the financing costs. They also mention a reduction in pro forma taxable income of about $24 million. This is likely due to the significant depreciation and interest expenses that are deductible for tax purposes, even though they might be non-cash expenses in the accounting statements. And perhaps the most telling number is this one, a projected decrease in cash available from operations by about $26 million pro forma. This suggests that while they've acquired, revenue generate free cash flow significantly. Now let's put on our investor hats and think about this. NERA has clearly made a bold move by expanding its real estate portfolio so significantly. They've acquired nearly double the amount of rental property they had before, which in theory should lead to much higher revenues and profits. However, the financial statements tell a more complex story. While rental income has increased, the overall picture, particularly their pro forma net income and cash flow, shows a substantial hit. The big takeaway here is the leverage. NERA has taken on a massive amount of debt to finance this acquisition. This makes them highly vulnerable to interest rate changes since a good portion of their debt is at a variable rate. If interest rates go up, their interest expenses will climb even higher, pushing them further into the red. Also, that negative partner's capital is a significant concern, implying the company's existing financial structure was already weak. The reduction in cash available from operations by $26 million is a very important point. It means that less cash is available for things like reinvesting in the properties, paying down debt faster, or distributing to partners. This acquisition might be a long-term play, but in the short to medium term, the debt burden is a major risk factor. They've certainly bought growth, but at a steep cost that could strain their finances. The company is betting that the increased rental income will eventually outweigh the cost of debt and that they can manage these properties efficiently. But for now, the numbers indicate a challenging path ahead. That's our deep dive into NERA's acquisition filing. What do you think about this aggressive expansion strategy and the heavy reliance on debt? Let me know your thoughts in the comments below. If you found this analysis helpful, please give it a thumbs up and subscribe for more corporate breakdowns. And don't forget to join our Discord community for more discussions. The link is in the description. Thanks for watching, and I'll see you in the next video.